Powell is with us, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, great to have you with us here. Thank you for your time. We'll talk about the bond market in just a bit and whether that'll start to hurt equities. But I just want to start with this Russia-Ukraine thing. Trump has kind of made it clear that he's ready to talk to Russia even though they don't stop fighting. I mean, even without a ceasefire. And I think it's pretty clear that Russia does not want to stop because they think they're winning. Now, this overnight news that Germany essentially allowing Ukraine to use their weapons to hit targets deep inside Russia, is that a new phase of the war in that sense? I mean, forget a ceasefire. We're now probably looking at escalation.
Good morning. Great to be with you. Yes, we continue to be in a very difficult geopolitical environment. And I think this is another example of how the investment kind of landscape that we're all trying to navigate is completely different to where we were perhaps 5, 10, 15 years ago, where with hindsight, I guess we can say at least at the global level, these risks, be it kind of normal economic stuff of high volatile inflation, tariffs, or much more seriously, the geopolitical risk, including military risk, clearly have moved from being relatively benign back in that previous era to a much more disconcerting situation now, which is something investors are going to have to learn. I'm afraid we're going to have to learn to live with. The idea that we're going back to a kind of benign macroeconomic or geopolitical environment, I think is extremely unlikely. So as investors, kind of waiting for the clouds to totally clear, I actually don't think is really an option. We're just going to have to learn to live with this kind of backdrop and try and navigate it as best we can.
Ben, hi, great to have you on the show today. And that's one part of the problem. The other is obviously trade, right? And we still don't know. I mean, there are no final answers. It seems the deal with the Japanese could be progressing quite nicely, given the statements that have been coming out. With the EU, now this whole 50% threat is looming. What's your sense, Ben? I mean, and even as these deals get done, I mean, eventually tariffs are going to be much higher than where they were before this, U.S. president took office. Have the markets adequately priced the slowdown or the quote unquote recession? I mean, the ground economy is still doing very well in the U.S., is what we understand. Your thoughts?
Yes. So I think you made a very important point there en passant, which is there's many things we don't know, but I think we can clearly say if we look at the UK, which is the one kind of trade deal that's done and dusted, that nominally at least is a friendly nation to America, and even the UK got hit with a 10% tariff. So I think maybe one thing we can feel reasonably confident about is 10% is something like a best case. Again, if that's the kind of rate that the deep ally, historic ally going back decades, even centuries gets, I guess we can assume that's kind of a best case scenario looking forward, which to your point means even hopefully as we get a bit more clarity on the many, many, many dozens scores perhaps of these trade deals being worked out in real time, wherever we end up is going to be a totally different place from where we started, much higher. And what that means for us as investors, we think at BlackRock, BlackRock Investment Institute, is inflation will be structurally higher. It's arguably a bit strange, but for political reasons, and fair enough, politics is a real thing. Obviously, voters do what they want to do. But the consequence of this should be a kind of self-induced inefficiency. We are deliberately injecting less efficiency into the trading system for political and maybe reasonable justification, but as a pure kind of economic outcome, making global trade less efficient, making it a bit clunkier, trying to move stuff away from where it's kind of cheapest to where you would prefer it to be with your friends or even at home.
But
politically, but economically, it should mean higher inflation.
But got your point, Ben. But simple question: can markets keep marching higher despite the reality you just described?
Yes, I think so. So on the equity side, clearly what we've seen in the last couple of weeks is the S&P, US equities ripping higher, more than 20% higher That's some people's definition of a bull market. So clearly, yes, equities can do fine, even with all of this going on in the backdrop, because, of course, these issues that you're raising are obviously extremely important and are going to continue to be so. But they're not the only game in town. And at least over the last several weeks, what we've seen is the AI, the artificial intelligence megaforce, has been sufficiently strong to be a big enough tailwind to offset even these very substantial headwinds. So yes, we at BlackRock continue to be overweight US equities. We fully understand there are many things to be concerned about. That's true and important. But there are also many things as equity holders that we like. And on balance, we think the tailwinds are stronger than the headwinds. That keeps us overweight US equities from here.
All right. Hi, Ben. Good morning. Good to hear that thought. And I think the last time we spoke as well, you did mention that valuations are still relatively attractive for the US markets and you'll continue to remain overweight US equities. Now, the point is that the dollar index actually has weakened. And normally that could see some kind of outflows, the kind of gush of money that we saw into the US equities. Do you think that could happen? And if that is the case, where does the money rush out to? Does it move to Europe or does it move to emerging markets, if in case you believe that could possibly happen because of the weakness we've seen on the dollar index?
Yeah, I mean, that's a fact, right? The dollar has weakened. That's true and important, and I think speaks to an important conversation that's going on in the market around US exceptionalism. Our view is the US is still an astonishingly, perhaps unique place on the planet, blending intellectual kind of capital, financial capital, and all of that. So that's still true and important. But to your point, I think there is a logical kind of consequence of this new, more fractured geopolitical order where we are going to look to diversify. Having all your eggs in one basket, even a beautiful basket like the US, feels a bit riskier given the volatility that we're seeing kind of all day, every day. So we would be looking to allocate carefully into other geographies, including selectively within emerging markets. So we want to be like picking our spots. Obviously, not all emerging markets are the same. So we would want to be cherry picking what we think are economies, sectors, markets which can benefit from these mega forces and do a better job, I guess, of being able to work through some of the headwinds.
All right, and Ben, India comes top of the list, or where do we feature?
We like India, yes. We think India is the right side a lot of these kind of huge tectonic shifts that we're seeing. So India, in terms of the geopolitics, where we started the conversation, clearly India is, of course, a kind of a continent-sized country and economy, and everyone wants to be friends with India. I think it's neck and neck at the moment, but potentially India's GDP will be overtaking Japan's relatively soon in the next few quarters. So India's heft, political importance, and I still think, if I can say so, what some of the foreigners still fail to understand is the amazing technological kind of productivity advances we've seen in India over the last years. That's not a news story, but it's kind of true and very important. So the combination of demographic growth, labor force growth, multiplied by ongoing productivity gains is a story we continue to like. So yes, India is definitely one of the emerging market equity index we would be favoring.
Absolutely. And of course, Ben, as I think many foreigners have pointed out, the diversity, right? I mean, the absolutely diverse group of companies, industries, businesses, not minerals focused or tech focused or this or that. I mean, it's everything in that sense. Thank you very much. Great speaking with you, Ben. Appreciate you joining us, and it's a pleasure having you here on CNBC TV 18. Till the next time.